All right. Hi, everyone, and good morning from Detroit. Let's get started. I'm Jennnifer Ablan, Editor-in-Chief of Pensions and Investments, and I'm with Wall Street legend Jim Chanos, President and founder of Chanos Co. We think it's an important time to have Jim on, given the spectacular collapse of FTX, and also what looks like a great time for short sellers. Jim, you renamed your firm. It was formerly Chanos Associates, and I wanted to provide some context on the name as it's tied to your Twitter handle, unless you want to do it.
Good morning, everybody. Thank you for joining. The Kinnikos, which was the name of the firm till we rebranded this year, were a group of ancient philosophers who lived in and outside of Athens. The most famous was Diogenes, and they believed in self-discipline and independence of thought as a way to fight demagoguery and look for truth. So you would recognize it as the root of the word cynic. They were the cynics. And back then in ancient Greece, it was not the pejorative that it has sometimes become in modern English.
Thank you again for being here, Jim. We really appreciate it. All right, let's dive in here with the FTX collapse, which has been the focus everywhere. We've seen bankruptcy advisors describe the collapse of FTX as a bigger case of fraud than Enron. You are famous for helping expose Enron's accounting scandal, and you were shorting the stock at the same time and made huge profits. You've been talking about a concept of legal fraud. It came out of the Enron story by your friend Bethany McLean. It's Bethany's concept of legal fraud, and Enron was the paragon of this idea of legal fraud. And what Bethany said, and you teach in your classes, is that in the financial markets today, almost everything you see that is questionable is technically legal. So it's been vetted by the lawyers and the accountants, but yet there's an intention to mislead. Is this what's happening or happened at FTX?
Actually, I think that this is one of the rare modern cases that is not legal fraud. This looks like pretty much outright pure criminality, with no one signing off on anything. As you know, there was no board here, and
also no CFO.
No CFO, and it looks to be on the surface, from what we know, and I'll give the caveat. We don't know everything yet, but from what it appears to be large losses at Alameda that were at the end of the day funded with customer accounts from FTX in one way, shape, form, or another, and covered up. And keep in mind, again, from first reports, we have that there was a software system designed to obfuscate that criminality from the allegations. So this Bethany's concept of legal fraud is one of the 5 models I teach in my history of fraud class, and in this case, I think we're going to find something just far more simpler. Now, I don't know that I don't think it's going to be bigger than Enron. We have to remember Enron at its peak was an $80 billion market cap company. And the hole at Enron was considerable when all was said and done. The losses to shareholders and creditors. This one is pretty blatant, though. This is up there with a Madoff type situation. I'm guessing we're going to find out that the losses were well into the billions, but probably not tens of billions. But it seems to be a fairly cut and dried case of commingling customer accounts for nefarious reasons.
So we've been seeing SBF make the rounds. I mean, he's been on Spaces several times. He was at the Deal Book Conference, also Axios, Bloomberg, others have interviewed him. I mean, why do so many journalists and big investors, I mean, why is he doing this? And why are so many journalists and big investors falling for SBF's story without raising any questions?
Yeah, I mean, and by the way, I mean, this speaking of my class, this started in April. In terms of, I remember I teach my class on Monday afternoons in the spring, and
Where do you do this, Jim?
I teach it at Yale in the spring and University of Wisconsin every other fall, and and the Bloomberg interview that SBF did with Matt Levine and Joe and I believe Tracy um, dropped on a Monday afternoon, and I remember reading it while I was having coffee before class and rushing up to my classroom for the AV people to try to get the interview put up on the screen for my class. I was just sort of stunned by what SBF was admitting in broad terms about the crypto ecosystem, not specifically about FTX or Alameda, but just broadly on how coins worked and how it was simply basically a Ponzi scheme, and that was right there. I think the first kind of smoking gun. And then from there on, he had his conference and was dubbed the J.P. Morgan by throwing money around, trying to rescue other troubled crypto companies. But I don't know. I mean, I think that he feels. I'm guessing he feels he's being tried in the court of public opinion. His lawyers will tell him that doesn't matter. You're going to be, possibly tried in a regular court. Um, but I can't tell you why he's doing this press tour. He may feel somewhat invulnerable being in the Bahamas, um, and but I don't think he's helping his cause.
Now, I'm going to bring up a couple of people up on stage again. We have Jim Chanos here with us. I am sending out invites, but apparently people are not accepting it. It's in your DMs. I want to bring in Markets and Mayhem here.
Hey, Jennifer, thanks for having me.
Of course. Go ahead.
Hey, Jim, I'm a big fan of your work. I've been following you for over a decade. I really appreciate the insights that you give, particularly on parts of the market where risk isn't being properly priced, right? And that's one of the things that I think short sellers do, and catching some grief for it. But ultimately, I think short selling is a really important part of the process. But we've seen things change a bit of late. Short selling used to be a little bit of a different ballgame, and one without such a focus on these glitz and glam short reports and the resulting large stock market impacts, at least on these individual stocks from them. It was more about doing research, finding that mispriced risk and capitalizing on it as it played out, as fundamentals deteriorated, as the macro picture might change. What do you make of the new glitz and glam short selling, where the report seems to do much of the damage, and maybe there's some moral vagary about that?
Yeah, so you're talking about short activism, I guess. It's not anything we've ever done. No, we go public on names when we think it's in our interest, in our client's best interest, and the market's best interest to point things out. But don't publish, long reports or put them on our website. So it's a different business model, and I know it's controversial. I will support anybody's First Amendment rights to express facts and have opinions about those facts, whether you're a bull or a bear. That's why we have markets, and I know people don't like it for the most part in the markets, but they haven't liked anything that short sellers do for better part of 400 years. So that's not really any change. And if you consider the long side, the long side puts out, long reports every single day on virtually every security in the marketplace, and people sort of shrug. Now there are rules that need to be followed if you're doing this right. If you're already short the position, you need to disclose that. Any conflicts of interest need to be disclosed. There's an issue about whether, if the reports are funded by third parties, that should be disclosed. And so all of these things within SEC regs need to be addressed. But we don't do it. But I support the right of anyone to publish on anything, long or short. I think that the marketplace of ideas is just as important as the marketplace of price. Now, you can't knowingly trade on or induce anyone else to trade on information you know to be false. That's securities fraud 101, and it's a crime if you do it from the short side or you do it from the long side. So of course you're subject to those guardrails as well.
Thanks, Jim. And I really like the point you made about how, sell side research is putting out these long centric reports all the time. So, what's the problem with the other side of that? I have one follow up, and that is, of all the shorts that you've taken, especially some of the lesser knowns, which one stands out as a case of just reckless mismanagement, and why?
Wow, reckless mismanagement. I would probably, you might get a laugh out of this. It would probably be the shorts I had on Donald Trump's bonds and his equity in the 90s. I joked at a fundraiser that it was like numerous slow-moving ocean liners hitting multiple icebergs repeatedly. It just seemed like everything he did in the 90s in the casino business was just one banana peel after another. And he kept repeating the same mistakes and then rolled up everything into an equity. And that, went straight down. It was really hard to lose money in the casino business in the 90s and early 2000s. And he managed to find a way to do it. So I think that would be my I think, simple answer.
Thanks, Jim.
Jim, I know we're jumping around a little bit. I just want to go back to crypto. So I know you're not surprised by this because you've been short Coinbase. You called its business model and exchange symptomatic of the predatory junkyard that is crypto. You noted its high costs in the industry as being a serious issue going forward, saying this is a really high-cost industry that needs lots of activity and needs really high commission rates to make money. Now, Coinbase's CEO, Brian Armstrong, said Coinbase's revenue is set to be cut by half or more this year. And Coinbase, I guess, let me just look at the stock. It's down about 84% this year. Are you still short Coinbase? And any thoughts there?
We are still short Coinbase. And Coinbase is symptomatic, and I think you highlighted a really important point about Coinbase and its business model. This isn't about crypto prices. That's not why we shorted the stock, and it's not why we remain short. I mean, crypto prices will obviously fluctuate. It's really the business model that I don't think people appreciate here. And as it relates to sort of the broader crypto ecosystem, what I pointed out was that the crypto industry, the paradox of the crypto industry is that they advocate for everyone to control their own crypto, to be decentralized. That's the nature of it. You don't want trusted third parties. Truth greater than trust. Blah 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 blah. But the simple fact of the matter is the cost structure is so high in the crypto ecosystem that they need you on things like exchanges at FTX or Coinbase or Binance. And to highlight that, I would just point out some simple numbers. At June and September, Coinbase had about $100 billion worth of various different crypto under its umbrella. And that was about 10% of the industry. Coinbase is running operating expenses of about $1.5 billion a quarter. So that's $6 billion annualized. So if we think Coinbase is somewhat representative of the cost structure, that's a drag of 6% on assets annually that they have to make just to break even. And I can't tell you how high a 6% overhead hurdle for a financial industry is. I mean, the equity market, it's a fraction of that. The bond market, even less. currency markets even less. And so the crypto industry needs lots of people trading and paying really, really high commissions and fees. And that's why it's aimed at retail investors. And just to give you an idea to sort of finish that thought, Coinbase is currently charging about 2.6% per retail round trip trade. So if you do 4 trades a year, if you're a retail trader on Coinbase, you have to make 10% just to break even. And compare that to commission rates on other financial instruments. I mean, it's obscene. In fact, compared to Coinbase's own commission rates on institutions, which are a tiny fraction of what they charge retail. And so at the end of the day, the business model of Coinbase is simply going to come under immense top line pressure as more and more traditional institutions allow you to house and trade crypto on their platforms. And keep in mind, these so-called exchanges are not really exchanges; they're platforms, and that's an important distinction. And then the final thing I would point out is valuation. On top of all that, we would point out that almost all fintech stocks, and this is historic, but it's happening today, that end up kind of structurally unprofitable or out of favor, end up trading at their tangible book value. You think about SoFi down at $4 or Robinhood at $9. These are companies trading slightly above tangible book. And tangible book at Coinbase, we estimate by the end of 2023 will be around $10 a share. So the stock is trading at 4 times that valuation right now, just to give you an idea of the risk reward. And so this is still an extremely expensive stock that is currently losing about $500 million a quarter.
Are you shorting anything else around this space?
So really, in terms of the crypto ecosystem, there's the miners, there's Coinbase, and then you've got like the odd one-offs like MicroStrategy, which is basically a giant closed-end fund of Bitcoin trading at a huge premium. But that's really kind of it. I mean, unless you go into and short the currencies themselves. So there aren't a lot of choices. So Coinbase is our prime short in that area.
Okay, we finally got Jennnifer Ablan up here. She is my enterprise editor, and she is one of the first journalists to uncover the Bernie Madoff scandal. She does have a few follow-up questions around FTX. Erin, you have to unmute.
Hi, Jim. It's an honor to be here. I was wondering how big do you think the crypto crash is? What kind of values are we looking at? We've seen, $2 trillion in value. And also, could you talk a little bit about the due diligence or lack thereof by some of the institutional investors like Sequoia?
Good morning. Yeah, so my guess is probably as good as yours. The off-cited number is down about 2/3 from 3 trillion to 1 trillion. If we look at Coinbase's numbers, which are pretty granular, their activity is down well more than 50%. Their activity is down, I think, about 60 or 70%. So it sort of fits with those kind of parameters. By the way, their business is about 1/3 Bitcoin, 1/3 Ethereum, and 1/3 all other coins. So it's a pretty good cross section. And if you want to get some granularity on the industry, I would urge you to read their shareholder letters, which are pretty detailed. I'm guessing that both the pricing and activity is probably down at least 2/3 at this point from the peaks in 2021. I'm sorry, your second question was?
The second question was about the due diligence or lack thereof.
Yeah, I mean, it was comical, but I think that it's not just not just crypto. I mean, we're seeing this kind of behavior based in Silicon Valley and the crypto ecosystem, for the past handful of years.
Mhm.
Look at the texts that were released in conjunction with people wanting to invest in Elon's Twitter deal. I
Right.
mean, I'll send you a couple $1 billion. In effect, no due diligence necessary. I mean, we've seen this now. This is the ultimate FOMO type market, and people are investing in personalities, not businesses, and that's a really scary development if you're one of the underlying investors in these investment firms who are throwing your money away at these kinds of situations with clearly no due diligence. I mean, Sequoia actually put out a journalistic piece celebrating kind of the insanity that was going on at FTX when they put their clients' money into it. Bankman-Fried was playing video games while he was being interviewed, and I mean, it's the whole thing. It's just sort of surreal. We're going to look back and say, what were they thinking? And the answer was they were thinking they didn't want to miss out on another big thing.
And do you foresee that there will be other VCs that will be revealed? I mean, we've looked at some of the institutional shareholders in Digital Currency Group and Coinbase and some of the others, and it's a lot of the same names. Does that surprise you?
No, I mean, I think that if you drank the Kool-Aid that this was the next big thing, you were going to drink a lot of different flavors of that Kool-Aid. So I think that that it's not shocking that you would see kind of some of the same names in a variety of these different disasters. And again, it was a money rush, right? If these firms were raising money, they were going to allocate you, and you'd better sign up quickly because you weren't going to be able to get in. And if again your pitch to your investors is that you're investing their money in cutting edge technologies, it all kind of fits. But we always forget that as bull markets go on, promoters and Wall Street will find will create entities for you to lose your money in. It's as old as markets.
So that
Jim,
would.
Sorry, go ahead, Erin.
So my one last question is, I know you're starting a new fund, and I wanted to ask what the strategy is, and then also, would you call this like a multi-asset bubble the last 14 years? And do you think that that's kind of created a generational short selling opportunity? And if so, what are some of the opportunities you see?
So I'll clarify. The fund that I think you're talking about is a UCITS form of a domestic fund that we already have, which is just the hedged version of our short portfolio. So it's not really new. It's just in a different structure to appeal now to a different regulatory regime in the EU and UK. So that it isn't a new strategy, but technically it is a new fund, and we're excited about it. So what two interesting points, and that is that I told clients and potential clients that 2021 was the most speculative year in markets I've seen in 40 years. Dubbed it it was the .com era on steroids. And I never thought after 2000 I'd see in my investing lifetime, investors do just completely insane things that they were doing in 1999 and 2000 again. And I was wrong. And I was wrong in a big way. I mean, the typical fundamental short we had in 2000 was sort of a $4 or $5 billion, Me Too telecom company or technology company that really did not have a good product or a business model that would ever work. And, stocks went down 80 or 90%. This go around, those types of shorts were 30, 40, 50 billion, if not even more. And it sort of 10x. And that's what's so stunning about what's happened. And on top of it, I don't think we appreciate in terms of 2020 and 2021 just the confluence of events that all came together in one kind of amazing witch's brew of insanity. And by that, I mean, you had $5 trillion of stimulus, fiscal stimulus, that was pumped into the U.S. economy. That's 20% of or more of GDP, almost 25% of GDP, was literally pumped into the economy in a little over 12 months. On top of the Federal Reserve zero interest rate policy and QE, so you had the most massive fiscal stimulus ever, on top of the most liberal monetary regime ever, all coming together post-pandemic. And when people talk about the amount of spending, I was at a lunch yesterday with Brian Moynihan, president of Bank of America, and I told Brian one of the best coincident indicators I like to look at is his bank's spending patterns. Every month they put out what the Bank of America's customers are spending on their credit and debit cards. And it's a pretty good cross section of America's spending, whether borrowed or earned. And he pointed out that from 2021 versus 2020, that number was up 25%. And for most of this year, it was up 10, 11. And it's only just decelerated. In November, it was up 5. And he said that over Thanksgiving to Black Monday, spending was up 3% year over year. So it's clearly decelerating fast. But, I mean, imagine, and I believe the number he said was up 40 or 40 plus from 2019 to 2022. So, I mean, that's unheard of, right? And so I think that if you think about what happened with corporate profitability and margins and all these things, coupled with really, really low interest rates, you couldn't find a better environment for speculation and for valuation to go crazy than late 2020, early 2021, and that's exactly what we saw. It was a bull market in everything.
How rough of the years were they for you as a short seller?
So 2020. So we measure ourselves with alpha because if you're short, I mean, our clients give us money to hedge their portfolios, and then our hedge fund takes out the systematic risk. So the SEC rules do not allow me to give you precise numbers, but what I will tell you is 2019 wasn't bad. It wasn't until the very end of 2019, when commission rates went to zero, that we began to see speculative activity start in a major way. 2020 was annus horribilis for us. That was the bad year. We had negative alpha, and there was no place to hide, particularly post pandemic as things really got going. And paradoxically, 2021 was a very good year, and 2022 has been a very solid year too. But 2021 was the tale of two halves. The first half of 2021 continued the 2020 trend, and then reversed abruptly in the second half of the year. So, I'd like to say the speculation kind of peaked in the first half or the first quarter of 2021, when we had, as you guys know, we had the confluence of meme stocks, SPACs. In February of 2021, SPACs were raising $3 billion in fresh capital every night. That was equal to the U.S. savings rate, as I've pointed out. So 100% of the U.S. savings rate was going into SPACs for a better part of a month, which is, just bonkers. You had the crypto takeoff, and then you had NFTs. And by the way, I don't think NFTs get their due as well for their little role in this speculative orgy. I know crypto seems kind of crazy, but remember the apes being sold for millions of dollars, the URLs of apes.
Yes.
Yeah.
Didn't Justin Bieber buy one of those?
I think so. Well, he sponsored one of. He sponsored one of them.
Yeah, he sponsored. Right.
Yeah, I think there's been a published report that he and his friends were benefiting on an undisclosed basis on that. I don't know if that's true or not. So, but the NFTs were right up there, and so with kind of stuff that you don't see at market bottoms.
So again, just going back to my opening statement, this has to be a great time for short sellers. Why do short sellers get criticized?
Why does the sun rise in the east every morning? It's as, it's as old as markets. I mean, it's truly. My friend Bob Sloan wrote a book about this, literally the history of short selling and markets, um, and and this goes way back. I mean, it's human nature, right? No one likes the person who's supposedly benefiting from the misery of others. That's not really what happens. As I've pointed out to regulators and investors for years, more money is lost because of margin purchases than is ever made on the short side in markets, right? I mean, if you wanted to help the little guy, you would restrict margin purchases as markets got more and more frothy. And by the way, the Fed used to do that. They don't do that anymore. And limit leverage, which kills small investors in every cycle. But it's really human nature. And then, of course, you've got agency risk, right, where you're pointing out often wrongdoing by corporate managements, and corporate managements don't really like that. So they're going to go out of their way to demonize anybody who's criticizing their malfeasance.
So you had mentioned that you are still short Coinbase, and you mentioned Elon Musk. This is probably a loaded question. What are your thoughts on Musk? I mean, we can talk about Tesla. Are you still short the stock?
I'm sorry, who was that? I'm joking. I'm joking. Yeah, we are still short Tesla. Yes.
You're still short Tesla.
We are still short, and I would at least like to point out, in defense of the long-suffering Tesla bears, that at this point in Tesla's stock price history, people have lost more money in Tesla than they've made. But I think that our view on Tesla is the simple observation that this is a car company. It is not a robotics company. It is not an AI company. It is not a robo-taxi company. And every bull market has a sort of it girl, if you will, that sort of epitomizes that bull market. In the dot-com era, I would have said it was either America Online or Cisco, where people put on just an immense valuation based on hopes and dreams, and not necessarily the business. The business can be an okay business, like Cisco's was, but if you go back and read research reports of Cisco at its peak, when it went parabolic, people said they were basically going to be in every aspect of internet hardware. But Cisco really just made routers and some basic network equipment, and that was it. And Cisco did fine for the next 10 years, but the stock went down 80 or 90%. America Online was, of course, an accounting fraud, which everybody forgets, that tried to hide it by merging with Time Warner, and also traded at just insane valuations because everybody was going to access the internet versus the AOL gated community. Tesla's a car company, and they were first, and to their credit, very well positioned with attractive, sexy cars. Most EVs, when Tesla had competition early on, were like just little bugs, and they came out with the S, which was a sexy sedan, and made it an aspirational vehicle, and for that, Musk gets all the credit in the world. But at the end of the day, it is a car company, and they're increasingly facing car company issues. They sell luxury cars, so their margins are higher than everybody else, but that's tougher and tougher to maintain because the luxury car market globally is about 4 million units a year, and the estimate for next year is that they're going to sell 2 million. So they're going to be 50% of the luxury car market globally next year if they hit their numbers. And the problem will be for them, of course, is decelerating sales. People are still expecting 40 to 50% revenue growth for the foreseeable future, and it gets really, really hard to put those numbers up the bigger you get. And Tesla is still trading at almost 20 times gross profits. And this is an incredibly expensive stock, even at $180 or wherever it is. And if you look at it in 2019, I mean, you'll see the parabola from what I'm talking about. I mean, it just absolutely was flat for 5 years, and then just went absolutely, parabolic. And I think that if you put any kind of normalized margins on Tesla, the average gross margin for most of the profitable auto OEMs is below 20%. If you put that kind of gross margin on Tesla's numbers, you're looking at a company that will at best make a couple dollars a share, trading at almost $200.
When are you going to take a short off of Tesla?
We have no idea, but we'll let you know when we do it.
Okay, good. Now let's talk about Elon Musk himself. This is a question that my good friend Matt Goldstein sent me. He wanted me to ask you about Musk, and is this his real self that we're seeing on Twitter, or is something else going on with him? Is it stress?
Is there a worse self? God, I hope not. Is this his real self? Look, I don't know. Everyone's entitled to their own, set of beliefs and politics. And, if you can afford to buy your own megaphone, God bless. Again, get back to First Amendment rights. He has every right. And he has every right, by the way, to do what he wants with Twitter. We're on Twitter right now, and
right.
It's his plaything right now, right? He owns it. He's the owner, so I respect that, and he has every right to cut us off here mid sentence. It's not free speech in the commercial space, right? The government can't restrict us, but the private enterprise certainly can and has the right to do it. I hope he doesn't, but he has every right to do it. I think it's a really expensive megaphone. I don't get the price he paid. It sounds like he doesn't get the price he paid, but that's a done deal at this point. I think he, it's pretty obvious that he likes the limelight, and this is just another vehicle for him to express that. So it's going to be an interesting journey, that's for sure.
Yeah. Absolutely. So I'm going to have Breakout Point ask his question here. Are you there?
Yes, Jennifer. This is Ivan from Breakout Point. So thanks for organizing this space. Can you hear me now?
Yep.
Excellent. So Jim, thanks for taking your time for the questions. So I have a few brief questions. So related to a broader short selling front. So one is if something especially caught your attention during this year in terms of these new public short calls, so in terms of you activist shorts, something where you said, oh, that's excellent work. And second question is in terms of specific area or sector which got in focus of short sellers during the year. So did you see something topical there in 2022? And do you see something for 2023? So we had SPACs maybe last year. Before that, we had Chinese stocks and so on. So do you see something new there?
So I look. We thank you for listening. By the way, in the question, we read all the reports. They get published. They get put out on the web and on Twitter. And I have my team. I've got a couple sitting in front of me right now that from the last couple of days that I haven't gotten to yet. And look, there's some people that do just spectacular work. Some are more well known than others. I'm a big fan of the guys at Hindenburg. I think they do good work. Nate Anderson does very detailed good work. I'm a friend and a fan of Carson Block's work. He's the one that kind of urged us to do a deeper dive on Luckin Coffee, which we had started to work on independently. I think Soren Andel at Blue Orca does good work. But every idea stands on its own merits, right? And as I support short activists' right to publish, their work needs to stand on its merits, and are they putting out interesting, good stuff that the market didn't know about, or are they just trying to move prices, which is not so good, as we discussed earlier. So with that, there've been a few areas that are thematic, and that I think some of the short activists, as well as people like us, are doing work on. One area that is, I think not discussed enough, that will be a focus going forward, 2023, 2024. That if I'm an investor, I would be redoubling my efforts on the long side and the short side, just to make sure that I wasn't being swept up in the kind of the narrative versus the reality, would be the whole ESG space. A lot of ESG stocks are basically at their highs right now, or near their highs. Solar stocks, geothermal stocks. I mean, companies that and what's interesting to us is that an awful lot of these business models just simply don't make any money, and have never made money, and are being valued on self-described metrics. One of my favorites is my old friend Sunrun, which is a residential solar panel installer. It's not even a technology company; it's a roofing company with a finance subsidiary. And they put the panels on your roof and lease them back to you. And this is a company that has negative EBITDA, has never made money. Go back and look at their financials for just years and years and years and years. And it's just simply a roofing company, right? And with in effect, a second mortgage subsidiary. So they sit on these leases, that's their asset, which are yielding, by our estimate, something like 4% cash on cash. And they'll give you this just tremendous convoluted calculation on how much value they're adding to shareholders every quarter, based on the assumptions that these leases are on the books for 20 years, then renewed with no credit losses, and then they discount it back. And this is the best part of all, just to tell you how silly some of these ESG companies are. Sunrun cut the discount rate that it discounts its cash flows back from 6% to 5% in February of 2021. Now, as some of you noticed, interest rates have gone up a little bit since February of 2021. But Sunrun, with a straight face, is still discounting back those cash flows at a 5% discount rate, even though on their last conference call, they said that their cost of capital was between 6.5% and 7.5%, and their bonds are yielding, their zero coupon bonds are yielding almost 11% in the marketplace. So, how they can, with a straight face, tell the world that you should be discounting these hoped for future cash flows at a 5% discount rate when they admit their own cost of capital is closer to 7%. I just think is outrageous. And there's lots of these in the ESG space. I mean, just really mundane, crummy businesses that are earning 3% on capital, 4% on capital, but are trading at 60, 80, 90 times earnings because they're seen as ESG green plays. And I think that's going to be a very interesting area on the short side going forward.
So you're short Sunrun, and what other ESG stocks are you short?
I'll leave it at that. We're short a handful of them, but since I've been public on Sunrun, we'll leave it at that. I mean, but it's a poster child. I mean, if you just look at Sunrun has just an incredible amount of debt and preferred on its books, and it has negative EBITDA. And in an environment where you're seeing the Carvanas of the world, talk about a possibility of bankruptcy, this company is it's shocking to me that their bonds are only yielding 11. There's distress in other areas, or bonds yield in the 20s and 30s, and it's never had positive EBITDA over any long length of time, as far as I remember. And so, at that point, if you're just simply, as I call it, a science project, you might want to reevaluate your business plan.
Okay, Jim, there are other questions in the queue. I'm going to bring up breakout reversal charts. Go ahead and ask your question, and thanks so much for your patience. You have to unmute. Are you there? Okay, let's go to Neely.
Thank you, Jennifer.
Of course.
Jim, in a prior life, I was on the sell side, and I had the privilege of working with Chanos and Emily Turner specifically, 8 years or so ago. I've had a front row seat to the depth of work that you and your team do, and it is astounding. It was always the hardest meeting, but I always felt, the most, honored, right, to be in those rooms. The thing that I've observed over 26 years of Wall Street has been legends and experts like you. You know what you know. You believe what you believe because of what you've put into what you believe. And yet there's still this third category. What do you not yet know that you will pursue relentlessly? I would love to hear from you if you'd be willing to share in 2023. What is it that you are relentlessly pursuing?
Well, first of all, thank you. And Emily was a special person. Is one of the best analysts I ever had, and had the pleasure to help train. And just an amazing person. Former Marine Corps officer serving in Iraq, and so thank you for that. And look, it's a great question. You always, part of this is you're never going to have complete information, right? No matter where you are in the investment food chain. And I would also point out that managements don't have complete information. And part of the reason for that is that, predicting the future is hard. And so you try to do the best with the information you have, and try to triangulate and get all of the pertinent available information that it's available to you publicly, and then begin to try to process it, what's important, what isn't. I would point out, and I had this discussion the other night with a bunch of old people like me, and we were pointing out that back in the 70s and 80s, and even into the 90s, the issue was getting the information, and we were all laughing, telling stories about rushing to the New York Stock Exchange or the SEC offices to get copies of filings before someone else had them, because companies would simply mail them out to you. There was no corporate websites or Edgar. And, if you had a 10Q a couple of days before somebody else did, you had an informational edge that was quite legal. And today, of course, most of us are on this little device that has all the world's information literally in your pocket in real time. And so today the information comes at you in a fire hose. And the key is not getting it. It's processing it and dividing the wheat from the chaff and understanding what's important. So it's really analyzing, not procuring the information. So it's a different game, and it's a arguably harder game, right? And so it's important then to, as you point out correctly, to also try to at least figure out what it is you don't know and may never know, and how important is that. And so whether both qualitative and quantitative, you pretty much can know most of the quantitative. The qualitative and the narrative that goes along with it is a lot tougher. Now, one other point, that is, there are lots of asymmetries on the short side, and that are bad, right? Just markets tend to go up over time. You have until recently a less favorable tax regime, and so on. But there's one really, really good asymmetry on the fundamental short side, and that is, as a fundamental short seller in a stock, I have no problem in getting what the well-reasoned bull case is on an idea, right? There are plenty of really intelligent, highly motivated people like yourself, on the sell side, formerly on the sell side, who will, for business, let us know what their thinking is, what their clients' thinking is, as to why this particular company is a great investment. So finding out the well-reasoned and well-thought-out bull case is not a surprise, and is available really for people to criticize or value or analyze. That's not always the same on the fundamental short side, right? I mean, not every investor knows what the reasoned bull case or bear case is, other than maybe some headlines, and the kind of work that fundamental short sellers do on the accounting and the business model and prospects, and so I do think there is still an information asymmetry in a lot of these situations that works to the benefit, and is one of the reasons why I think the alpha is still high on the fundamental short side. And then finally, what is it that we're trying to, that we don't know or think that we need to do more work on or whatever? I mean, it's nonstop. I mentioned the ESG area going forward. I think that's an area that's really, the more work you do, the more interesting it gets. And then it drops off. I mean, we're still bears on China. China is often a situation of triangulating on the individual companies, and there it's clearly what you see is not what you get. You have to dig deeper in the individual situations in shorts related to China, certainly. And then after that, I'd say it's pretty idiosyncratic. We're pretty bearish on the commercial real estate space. For all kinds of reasons, and there, of course, it's really idiosyncratic because not all properties are the same, and every local market is a little bit different as to what's happening with leasing and rents, and but that's the commercial real estate story is as much an accounting story as anything else, and that's a separate issue. But yeah, it's a good question.
Thank you. Wishing you all the best in 2023.
And to you.
Markets and Mayhem, I know that you had a couple of other follow-up questions about Jim's shorts.
Thanks, Jennifer. Yeah, Jim, I was curious about one of the shorts that was recently disclosed, Square. You had mentioned Coinbase, and the primary reason there was crypto. And I know Square is less of a crypto-centric company, but I was curious about your short thesis there and if crypto played into it at all, since Square has a reasonably large crypto holding as well.
Yeah, so I actually put something out yesterday on this on Twitter. It is not because of their crypto business. Their crypto business is large in terms of top line, but it's not very profitable, and they tell you that. It's an ancillary to their other businesses, Cash App, but what really got us kind of interested in Block, the old Square, was when they paid just an insane price for Afterpay, which is one of the largest buy now, pay later companies. And just a couple of observations. Block also is one of the poster children for a theme that we've been kind of harping on for a while now, which is the insidious cost of share-based compensation. And if you look at SQ's expected adjusted earnings this year, I think it's a little bit north of $1 on Bloomberg. So the stock is trading at 60 times that, which is bad enough, right? But if you actually look at the GAAP numbers, they're losing money. And the difference is obviously for most of these types of companies is share-based comp. And I want to point out something to the listeners that they may not appreciate about share-based comp. That's a really important concept. And this happened in the .com era, so we have a little precedent for this. And that is when share-based comp is issued every quarter, the accountants figure out what is the expected value of the options and RSUs that the grantees are getting, and they put it through a Black-Scholes model or whatever, and value that block of equity and options at a dollar value, as they should, and that's the value of share-based comp. But here's the important part. What everybody forgets is that if you have a very acquiescent management and acquiescent board who, if the stock goes down subsequent to the issuance, adds to the share-based comp to offset the fact that a lot of the equity comp is now, quote unquote, underwater that you gave out like in the last quarter or last year, and you actually give out more share-based comp in subsequent periods because employees feel entitled to it, well, then in effect, at the original issuance, you've issued puts as well as calls. Because you've told the employee, look, if the stock goes down, we're going to top you off. And nobody is valuing these grants as if they're both puts and calls. They just value them as if they're calls. And it means that the cost of share-based comp in a highly volatile situation is far higher than they're actually putting on in their GAAP financial statements. And it means that possible dilution is far greater in a highly volatile situation than what the companies are letting on. It's a really important concept that, I've railed about pro forma accounting now for years, and it's an area I do believe the SEC could be doing more on just the wholesale use of pro forma accounting. And this is one area, share-based comp, because of this little asymmetric observation, is screaming for more regulation, in my opinion. So getting back to SQ, they are a massive issuer of share-based comp. But on top of that, I think their business model is far riskier than people think. I put a bar chart out yesterday on the buy now, pay later companies' delinquencies and charge-offs. And if you look on my timeline, you'll see it. And Afterpay is right now is showing 20% delinquencies, and the charge-off rate I think is somewhere around 5%, whereas most of the others have charge-off rates kind of hugging closely their delinquencies, because the recoveries in buy now, pay later debts are de minimis, and so I think there's a risk part of SQ that people aren't really appreciating here. And meanwhile, the pure buy now, pay later companies have been plummeting. Companies like Affirm, and so there's risk, a lot of risk to their business model there that people are not appreciating. And again, if you get back to what I talked about earlier in the spaces about fintech companies trading at tangible book that are structurally unprofitable. Tangible book here is, I think, single digits with the stock at 60. So it is an unprofitable company, and every bull market since the mid 90s, people have gotten excited about fintech. That just investors are drawn like moths to the flame to the idea that you can lend money to uncredit-worthy people over the internet, and somehow that's magical. And every bear market and recession, they find out it's not. I don't think Block will be any different.
Thank you, Jim. And it sounds like we're getting into that environment where there's going to be additional stresses on their business model, because in a recession, there's going to be increasing risk of default. People are going to be walking away from that debt. So it sounds like it's just going to be a more and more challenging environment for an already unprofitable business there.
Yeah, and they've also, there's been good reports. I mean, they're also beefing up things like their payday lending. So this is really becoming like a subprime lender, trading at just massive valuation. And again, subprime lenders with low recoveries tend to not do well and tend to trade at pretty low valuations. This one is trading at a pretty high one.
All great points. I just had one more follow-up about your shorts. You had also mentioned IBM, and I've been following them for a bit. It seems like they've had a troubled transition. Management's not executing too well. There's some core questions about the viability of their business model over the longer term. What are your thoughts there? What's your cause for getting into that short?
Yeah, so IBM's an accounting story, and it's just that simple. And it's actually benefited this year from being a so-called value technology company, which I giggle at. IBM, IBM is a body shop. It's not a tech company, and nobody's going to work for IBM because of the bright technology future it has. And let's be clear. But more importantly, the most profitable sector of IBM is the CFO's office. This is a company that for years has reported, adjusted numbers, adjusted for this and adjusted for that. We have a really simple metric that we use with IBM. We just basically look at what are their operating earnings, their GAAP operating earnings, with plus IP and royalties, which is a legitimate business for them, minus interest, and taxed at 21%, the statutory tax rate. And if you do that calculation and do it over time, IBM's current, what I would call economic earnings, are $5 and change. And they're going to report an adjusted number this year of $9 and change. Now, $9 with the stock at 150 is the most expensive this stock has been in a long, long time, like for almost decades. And it's become pretty expensive for what it is for a non-growth old technology company. But if you think that the earnings are something like $5.60 in reality, then it's trading at a big premium to the market, and that number has declined obviously slowly over time. That $5.60 number. So IBM is playing kind of all the great accounting games you can play, has been for years. What's interesting about it for this year versus next year is, in order to play the last set of games, they did this Kyndryl spinoff, which they have just anniversaried the 1 year of. And when they did it, they saddled Kyndryl with some contracts that are very economic to IBM and uneconomic to Kyndryl. I would point you to a published report earlier this year. They were interviewing the new Kyndryl C-suite, and they pointed out a clock that Kyndryl has up on its wall. And the clock is when the IBM contracts run off. So that ought to tell you something about the benefit of the spinoff to the old parent. And these are the kinds of things that IBM's been doing now for the last 20 years. It's been a story of financial engineering, not really innovation. And on top of that, they're getting a benefit this year from the mainframe cycle, which goes every 4 or 5 years. That's going to turn into more of a headwind going forward. So earnings estimates are going to keep coming down. It was seen as a high dividend yielding stock, but with higher interest rates, that's a lot less appealing. And it's never been more expensive. And in fact, if you look at it on an enterprise value to EBITDA basis, IBM is basically starting to be right up there with a lot of the FANGs in terms of how expensive it is. And that's never been the case. I mean, those companies that have their issues, but they're still growing 20 to 40% with 20 to 40% returns on capital. And IBM is single digits, if that. So for it to be valued the same as the FANGs is kind of absurd.
Thank you so much, Jim. And I really appreciate the depth of research that you do. And it brings up just one last question I had for you. It's from my partner, Aisha. She asks, what's the first thing that you look at when you're looking at a balance sheet, when you're beginning to research a company?
Well, obviously everything's different when we look at companies, but we're big fans of two things when trying to analyze balance sheet and returns. We're big return on capital guys, so we really want to see the true pre-tax return on capital below the cost of capital for us to kind of get interested in a short idea. That is, so is the business fundamentally profitable? I mean, you can show profits, but if your ROIC is below your cost of capital, then economically you're not profitable for the risk you're taking. And that was the tip off on Enron, by the way. The real exciting first blush on Enron was that on a reported basis in 2000, they were earning 6% pre-tax on their capital, and because their balance sheet was so big with derivatives, and that was below their cost of capital. So if a company is growing very rapidly with returns below their cost of capital, they're liquidating. They just don't know it yet. So that's number one. And then number two, we will look at are certain asset accounts growing faster than the business. So particularly in consumer companies, you don't want to see, for example, inventories growing twice as fast as cost of goods sold. That's a huge red flag that you've got cost issues that you haven't addressed that will probably hit the bottom line sooner rather than later. And are there odd prepaid expenses that are not being run through the income statement? So you can everything has to foot. So you can get a good sense. Our inventory is growing faster than payables. That would be a possible indicator that costs are being capitalized. It's not just widgets sitting on your shelf, but it's actually capitalized costs in that inventory account that are going to have to come out. Is the depreciation realistic to the capital? That's been our thing with our data center shorts, for example. The data centers are operating businesses. They're not really real estate plays, and the CapEx is greater than depreciation. And all the data center executives are telling the street that maintenance CapEx is just a fraction of total CapEx. But the fact of the matter is, if you do the numbers, what they claim is maintenance CapEx on these very capital-intensive data centers is something like 100-year to 150-year life, which is, of course, patently absurd. And so, those are the things you can glean from the balance sheet that have an impact on valuation. But our first stop is return on pre-tax return on invested capital, and that almost rarely lies.
Thank you so much, Jim.
All right, I'm going to turn it to Trent Wizzo. Thank you for your patience. Go ahead.
Hey, Jim. Thank you for sharing your thoughts and wisdom in this in the Twitter Spaces. A couple of questions. So, first one is, you had unearthed the China real estate short very long time ago. Do you see some elements of that from the last 18 to 24 months in the U.S.? And if yes, which pockets? The recent Blackstone REIT gates that they had raised because they didn't want to sell their inventory at fire sale prices was one such indication. But any work on that, any updates on that would be great. Or any other player, right? Be it Acre, be it AGNC, so on and so forth. And the second part is about, along with your fundamental assessment, do you also do any flow assessments such as share repurchases? At the peak of earnings cycle in March 2022, we saw that there was a massive component of buyback as a way to give back capital to the shareholders to the tune of almost $980 billion on top of the dividends which were around $460 billion. Now, companies, as they realize that they're getting into this macro patch, they're going to have to cut back on one of the two to potentially maintain their dividend aristocrat status or whatever it is. They may not do that but for the dividend side, but definitely on the share repurchase side, there would be a challenge. So that's a flow question. So first question is on real estate. Second is on especially domestic U.S. real estate. And second is on the flow side for the stock repurchases. Do you have any ideas that have come to your mind? Or do you even assess that?
So I'll start with the second question first on the flows and buybacks. One of the best coincident indicators of the markets are buybacks. I mean, we don't have a huge time series, but if you look at buyback activity, it tends to track the market kind of with a positive correlation. That is, managements get more confident at the top, and buybacks dry up at the bottom. I mean, there were almost no buybacks in the first quarter of 2009, which would have been a great time to be buying back your stock, right? It was cut in half, and management's, closed up the pocketbooks. And meanwhile, record buybacks in 2021 and early 2022. So that's number one. Buybacks are as much a coincident indicator of the markets as anything else. But I would add to it more recently a more insidious observation, and it gets back to our one of our last comments, and that is we're beginning to see an increase in buyback activity in Silicon Valley, of all places, because of all the share-based comp they've issued. So in recent quarters, you've had companies like DoorDash and Zoom and Salesforce.com embark on really big share buyback programs, not because they think their stock is cheap, but to offset all the SBC, all the share-based comp that they've issued. So think about that kind of a paradox. On one hand, they're telling you, that you should add back share-based comp as a non-cash expense to your pro forma earnings. And then on the other hand, on the cash flow statement, they're now having to buy back stock to offset the dilution. That's a pretty interesting dichotomy, if you ask me. But so buybacks, are A, coincident, and B, we have this new sort of thing you have to pay attention to, particularly in the technology area, of buybacks that are offsetting share-based comp. That's number one. Real estate. So our view on domestic real estate is different from what we were pointing out in China back in 2010. Our concerns about real estate in China in 2010 are today the same as they were back then. It's more of a macro issue. Real estate is the fundamental driver to the Chinese economic model. It has been for years and still is. Residential real estate is take your pick, 20 to 30% of Chinese GDP every year. And overall investment is still between 40 and 50% of the Chinese economic model, which is just a staggeringly large number. Just to put that in perspective, investment in Western economies is usually between 15 and 20% of GDP every year. And in China, it's 2 to 3 times that. So China is just one big construction project and has been for years. And that means that there's obviously some interesting offshoots of that. I always joke that China is the only advanced economy that knows what its GDP will be on January 1st of that year, because by such an investment-driven model, if you dial up investment, you will dial up GDP. The problem is financing it. And it means that you run just enormous domestic financial credit risks, which we know China has. China's banking system is functionally insolvent. Chinese banks trade at 0.2 times book value. So the issue was really the nature of real estate and construction in China and how important it is to their economic model, and that hasn't changed. And sooner or later, it becomes so big that it dominates the credit system, and I think we're at that point with China. It's just now they're trying to figure out how do they get off the back of that particular dragon, and I don't, I joked it was the treadmill to hell, and they're still on it trying to figure out how to get off it. Now in the West and in the U.S., the real estate, it's much different. I mean, real estate is a much smaller part of our economy. The problem I have with commercial real estate in the U.S., and this is an area we were shorting commercial real estate back in the late 80s when the tax code changed and when there was just a massive overbuilding, before the tax code changed in 86 and 87. It brought, helped bring on the savings and loan crisis in 89 to 91. The problem is cap rates, right? That so much real estate has been put in place both pre and post pandemic at just incredibly low cap rates. Think industrial warehouses at 3% cap rates, apartment buildings at multifamily at 4 and 5% cap rates. And for those of you who don't know what I'm talking about, cap rate is simply gross cash flow, NOI, before corporate overhead and before depreciation and interest, divided by capital employed. And it's all well and good when interest rates were 1%, but when interest rates are 4%, a 3% cap rate is a whole different animal. And furthermore, for the publicly traded real estate companies and REITs, there's a few problems. Often SG&A is a meaningful part of capital. It's typically 50 to 150 basis points, depending on the company, of capital is just in overhead. And then number two, unlike a lot of private real estate entities, there's a lot that you can capitalize in CapEx that doesn't show up in NOI in the real estate space. And that is tenant improvements, tenant concessions, commissions to release space. All those things are capitalized and amortized over the life of the lease. So that can be considerable, depending on the business and the nature of the properties. So when you couple those two, a 3% cap rate set of buildings might not be yielding almost anything on a cash basis. And that's the problem that commercial real estate has in the U.S. Just the cap rates got really, really low. So if you look at offices, for example, office rents peaked in 2018, 2 years before the pandemic, because of overbuilding. And so the pandemic obviously has accelerated stuff, but offices were probably going to get into trouble even without the pandemic to some extent. Certainly not as much as they are now. But just to kind of give you a good example what I'm talking about, and I posted on this, SL Green, the big New York landlord and New York office REIT, had an investor day this week, and they brought guidance down for next year, as they should have, and the stock got hit. But by our numbers, SL Green is trading at a really, really low cap rate even now. They're trading at numbers that kind of are head scratching. Before their cut in guidance, their look through NOI, their NOI from both their consolidated buildings and then their proportionate share of their net operating income of their unconsolidated buildings, was about a $700 million annualized run rate. And if you take a look at their net debt and preferred, both on their books and then the look through on those same buildings, plus their equity cap, that was about a little over 16 billion at the beginning of the week. So 700 million divided by 16.2 billion, I get a number that starts with a 4. And if I told you, you were buying New York City office buildings at a 4% cap rate, you'd think, you were crazy. But that's where it trades at in the stock market. So I'm kind of stunned. You can put commercial real estate in that group of businesses that were just massive beneficiaries of the Fed and low rates, and assets got marked accordingly. And I think that the returns there are going to be very problematic going forward in almost all kinds of commercial real estate.
Jim, we've taken up a lot of your time. It's already 10:18. Can you take a couple more questions, or do you need to?
Yeah. No, I'm good. Go. We're fine.
Okay, so you brought up the Fed. I'm kind of curious. What did you learn from being on the New York Fed Investment Advisory Committee?
I was on that committee for a long time.
Yes.
Yeah, and it was an interesting. I mean, the minutes are public, so you can go there. And other than that, it is not the stonemasons from The Simpsons. Where everybody's sitting around figuring out how to rule the world. It truly was an advisory committee. The the New York Fed officials would solicit opinions from us. I think I was there primarily for my China views, actually. But they asked me to join right after we had gone public on China. And so I think it's actually a good process for the Fed, as long as the rules are kept and the information goes one way, which was certainly the case, when I served there.
And you were on that committee with at the time with Bill Ackman and Scott Minerd, right?
Bill was on the committee. Scott was on the committee. A whole host of people you probably would know were on that committee in the 10 years or so I was on it. And they solicit views. And look, I mean, the people around the table disagreed, right? I had a view on China that was diametrically opposed to a couple of the other participants. And we would hash out a debate. And I think that's actually a good thing for Fed officials to hear, right? To get opposing viewpoints in the marketplace. Did you consider this? Are you worried about this? What about this? And so I think that's. I think they have an FX committee as well, and they have possibly a money markets committee, advisory committee. So I think they have 3 or 4 of them. And ours, the one I served on, was the broader sort of investment advisory committee, which had to do more with stocks and fixed income.
So what do you think of the Fed's tightening policy now?
I'm not a Fed economist. I like a lot of people, I thought they were just way too easy, both pre and post pandemic. But just keeping the easy policy when the fiscal stimulus was just so enormous was just I think was an obvious policy error, and people were pointing it out at the time. And so I think that that became a problem. And they've done one thing that hasn't been around for 50 years, right? For the very first time in 50 years, we're seeing the return of inflation. Now, inflation could go back down, and probably will. But prior to this, in my investing career, over 40 plus years, we've seen interest rates only go down and inflation only really go down. And if that's no longer the case, if we now know that large amounts of monetary ease and fiscal stimulus can bring back inflation, which it clearly now appears it can, that's a change to the investment landscape that almost every investor has not seen. I'm sadly a little bit on the older side, and I didn't see it. Right, I came in just as it was peaking, and so there's literally only a handful of people on the street that have ever seen what happened in the 60s and 70s, and I caution people, that between 1966 and 1982, the real returns for financial assets, particularly equities, were a disaster. They were the equivalent of the Depression. I think equities on real terms were down almost 90%, and bonds in real returns had despite high coupons, had negative returns. So if you were on Wall Street, there were literally only a handful of people who survived careers on Wall Street from 66 to 82. The number of people when I got on the street in 1980 that were around, they considered themselves to be either lucky or they were already independently wealthy or whatever, because everybody was out of a job. And I pointed out to my friends on the street, and they kind of laughed nervously. But I point out, gang, if we ever get back to a situation where you have high nominal growth, there was very high nominal growth from 66 to 82. It just was a very bad environment for financial assets and for Wall Street. I said, you'll all be out of jobs. There won't be anything to do. If you lose your clients 80 or 90% in real terms, they're gonna go to cash or do whatever people did in 82. And all of this lovely infrastructure that we've built in the last 40 years on Wall Street is going to crumble. And it's obviously a right tail event, but it has happened before. It happened in my lifetime. And
how much more downside do we have here?
I have no idea. I mean, I pointed out. Everyone has their own analogs, right? And
right.
we're all subject to recency bias. So the last thing that everybody remembers is the global financial crisis. Well, that's not how it's going to play out. I don't think. I think look at the bear market that was before that one. So in 2000 to 02, corporate earnings dropped 32%. The S&P dropped 40%. The NASDAQ dropped 80%. It was every bit as bad for equities as the global financial crisis. It dragged out longer. It was 2 years. But it was every bit as traumatic as the GFC. And if you look at GDP, GDP was roughly 2% in 2000. It was 1% positive in 2001, and then it was back to about 2% in 02. I think there were 2 quarters of negative GDP in mid 01. So that's where the recession technically was. But there was never a year of negative GDP in that bear market. So the economy continued to grow. Consumers did okay. And corporations had just a horrific time. Profit margins collapsed, and equity values collapsed. But the economy did fine. Why can't we see that situation? I mean, every situation is a little bit different. Human behavior is different each time, but we all are prisoners of sort of our own mental models, and the idea that it has to be like a GFC, and if the conditions like the GFC don't exist, then you can't have anything bad happen. It's just silly. And I would point out one other thing, that is, on top of everything else, valuation, whatever, corporate profit margins are kind of 50% above the norm right now. So we have high multiples, high valuation on high margin businesses, and that is a set of risks that you need to be cognizant of.
Thank you, Jim. I'm going to bring up Reggie now. Thanks for your patience. Reggie, you can unmute. Reggie Middleton, go ahead. I guess he's not there. Are you there, Reggie? All right, Storm City.
Hey, thank you so much. Great space, Jennifer, and Markets and Mayhem. I feel extremely lucky to be up here with a legendary Wall Street veteran. So thank you, Mr. Chanos, for your time today. So many questions to ask, and I posted in the nest about Blackstone. However, I wanted to get your thoughts around long-term capital management and what occurred and the equivalence of, maybe the modern day Madoff and FTX. And then I had a Bitcoin question, and I noticed Fidelity adopted it in its, platform. However, my concerns are around the derivatives and maybe the leveraging and manipulation around it. And just your thoughts on, is Bitcoin similar to other utilities as far as coins? I don't want to derail the conversation, but I'm just kind of curious your thought process, if it's a standalone asset that has a utility in the financial markets, or not at all, or maybe not in the foreseeable future. Thank you so much. I'll drop down as a listener. Appreciate your kindness and time today.
Yeah, thank you. Just help me out in terms of the long-term capital management. What was your question specifically on that?
Well, where I'm wanting to kind of get at is, during that time frame that was, a catalyst, that drove in the 90s, and we're seeing some of the dominoes as far as the pension out of London,
Okay.
and then
Yeah.
FTX. Do you foresee Blackstone and or FTX, these dominoes or shoes that are dropping, kind of like catalysts on the horizon that may have some volatility in the market? Do you have, because I've heard the word global recession and debt ceiling, which I don't believe anybody's really talking about, but these are causations of concerns. So that's kind of where I was frame of reference, since you have a lot of experience.
Yeah. So one of the things about Bitcoin and FTX, and people kind of add, where are the regulators, and why was this allowed to happen? These dominoes, falling so fast in 2022, and that's a whole separate discussion. But one of the things that I would point out is that one of the reasons why the regulators seem to have kind of taken their time in their turf battles between the SEC and the CFTC, and Congress being supportive and now being outraged, as Congress always is that these collapses, by and large, I think it's fair to say, are not putting the rest of the global financial system at systemic risk, right? So LTCM was important because those guys were leveraged like 100 to 1, and they had credit facilities from the various different banks and brokerages around the globe to maintain that leverage. So if they went under, there was going to be collateral damage to their lenders. And so that's why the Fed had to organize a rescue in the fall of 1998. It wasn't because of LTCM. It was because of LTCM's the loans that LTCM had from banks and brokers. So it was systemic. And that's an important distinction. That's the one thing that will get the central bank and regulators moving quickly if they think there's systemic risk. And for the case of crypto, for the most part, it's been non-systemic, right? It's been like NASDAQ. It's been a lot of speculators who made a lot of money and then lost a lot of money, and that, I think, is unfortunate, but it's not. It doesn't put it first and foremost. Now that you have evidence of fraud, I think that's going to add to that, to add to the concerns and the call for action. One of the things I teach is that the fraud cycle follows the financial cycle with a lag. And the longer that you have a bull market going on, the more people's sense of disbelief is eroded, and they begin to believe things that are too good to be true. Like this link to an ape is worth $500,000. And so it becomes just a haven for fraudsters who are there to separate, gullible investors from their money. Again, not to beat the NFT dead horse, and I'm sure there's probably an NFT of a dead horse out there somewhere. But I mean, the amount of wash sales that was going on in the NFT space was just absolutely hysterical. And it wasn't really hidden that much. You guys all remember the thing that set that off, right? Was the Beeple auction for $69 million.
Yeah, I remember that. There's a
remember
huge
that?
celebration all over.
Oh, that's what kicked it all off. And then it came out in the FT after that, in a lunch with the FT column, that Beeple was in partnership with the people that bought the NFT for $69 million. And so, that just set off alarm bells in my head, that when the artist is in business with the people who buy his art, did he really sell it? And what was behind the scenes? I don't know, but the fact that he was in partnership with the consortium that bought the artwork should have been just front and center in every media report about that sale, and it wasn't. It came out kind of quietly later. And so these sorts of things, just scream for regulatory oversight, but sadly don't get addressed till people lose a lot of money. So that's the LTCM and crypto kind of connection. I don't think until now that there really was a call to action, as it relates to the marketplace and the government kind of getting involved, because it hasn't been systemic. And there are regulatory, questions. And remember, these guys are pretty much all offshore. Coinbase is domestic, but almost every other exchange is not U.S. I've joked there's a reason that everybody's in the Bahamas and Dubai. It's not much of a joke anymore, and so all those issues are really important as it relates to that. As it relates to the Blackstones and whatever, again, I don't think the issues are systemic because interest rates are still so low in places like the real estate market. I think it has more to do with valuations. That just the massive windfall that real estate investors have gotten is going to be a lot more difficult going forward. But I don't see a lot of commercial real estate concentration, with a couple of exceptions, in the books of on the balance sheet of commercial banks, for example. It's more non-traditional lenders and private funds that have provided a lot of the capital, and so that there's that. And look, I mean, there's just so many areas that after this last 15 years, you can kind of get worried about. One of my favorite worries is private equity. And just the cascading amounts of money that have gone into private equity because the returns have been not only good but not volatile. And I just am very worried that large pools of capital who now have 40 or 50% of their assets in privates and venture capital don't realize that they're leveraged long equity, and haven't paid any prices for that until just recently. And so that's a whole asset class that deserves a lot more scrutiny than it's getting. But we'll find that out with the passage of time. But right now, this is not I mean, China has systemic risk in its banking system. That you can point to it, and they know it. And their financial institutions trade like that. That's not the issue here. Not in this cycle. So we're always fighting the last war. And so, we kind of addressed systemic risk after the GFC and tightened things up, brought leverage down in regulated financial institutions and what have you. So the risks are happening somewhere else. And I suspect they're on the equity side, not the debt side.
Okay. May I still jump in? I apologize.
1 second,
couldn't find the unmute button.
One second. Storm City, did you get all of your answers?
Yeah, absolutely. Thank you
Okay.
so much, Jennifer.
Okay.
Just would love to play poker with you someday, Jim Chanos. Really appreciate your time today. I'm gonna drop down and listen. What a great space.
Great. Reggie, why don't you jump in now?
Okay. To begin with, I'd like to applaud and laud you for your call on Coinbase right after the IPO. The unsustainable business model apparently wasn't visible to everybody, despite the fact it seems to have been visibly unsustainable. I wanted to ask, most don't seem to realize that most of the centralized institutional crypto space is built upon patented technologies, patented by multiple parties, not simply one. And with full disclosure, I'm one of the patent holders. We're in litigation with Coinbase right now. We allege that roughly 90% plus of Coinbase's revenues are derived from patented technologies, of which is unlicensed. You combine this with the unsustainable business model, which they are trying to diversify, but I don't believe they will be able to do it in time. Increasing regulatory pressures and the high volatility of the trading assets that they derive most of their revenues from. And these are businesses that won't be in existence in their current form roughly 2 or 3 years out. My assumption is that they're going to be acquired by the large traditional financial institutions who would have a problem building this out from scratch, but would likely love to buy Coinbase, pennies on a dollar. That's question one. I want to know if you agree. And also, I caught the tail end of your discussion with Block, and Block is under the same um, under the same purview. The Bitcoin business and block is not necessarily high revenue because the way they account for it, they account for the purchases of Bitcoin as revenue, when the spread between their purchase and sale of Bitcoin should be their gross revenue. It appears to be legal under GAAP, but it's also very misleading from an economic perspective. So I just would like for you to comment on those. The block has a lot of competition for Apple with their point of service through the iPhone, their buy now, pay later, which I heard you discuss is, a losing proposition for right now. And their attempt to move into crypto for distributed payments at low cost, which again is patented and they're not licensed. So just wanted your opinion on those.
Okay. Well, I won't comment on your lawsuit against Coinbase, but it's interesting in that Coinbase is challenged, most fundamentally on their commission driven model. But I will point out one funny observation this summer, and that is the sort of bold narrative tried to pivot, and sell side analysts recommended Coinbase because of the rise in interest rates. And why would you recommend it? Because of a rise in interest rates? Well, simple. The company and its supporters pointed out that Coinbase was not going to pay customers any interest on their, in effect, on their cash balances. And so I kind of like it. Just I had to chuckle because so let's see, we're overcharging our retail customers on commission rates, but we're going to offset some of the problems that brings on by not paying them interest. It's like you can't make this up. You can't make this up, right? Like neither of those are sustainable business models in a competitive environment. And so.
To delve even deeper than that, because we've done a lot of work on Coinbase. Coinbase is pushing their cash balances into USDC, a stable coin, of which they're in partnership with Circle with. The business model for asset-backed USDCs has a perverse incentive for anybody who buys a token. Basically, you give Coinbase Circle $1 billion, they give you $1 billion USDC, and then they invest it and they keep the yield. So the purchase of USDC is basically return-free risk. You take all the risk, you get zero the return. Yep. Coinbase is essentially a shadow bank that is junk rated. Its bonds are down 45%. The short-term bonds yielding more than the longer-term bonds, with 13 to 15%. Their share price is down 89% from IPO. The market has it down 45%. Moody's has it at BA2, BA3 with a downgrade review. It's basically a very, very high risk. So you're taking the counterparty credit risk of Coinbase, the counterparty credit risk of Circle, which had a going concern warning a year and a half ago, and the investment risk, and you're getting in return absolutely nothing.
Yep.
So, you're absolutely right in laughing at that. If you peel the covers back just a little more, the joke is not even funny.
Yeah,
so
no, every aspect of it is just kind of insane when you look at it, and why this trades at multiples of tangible book, and let's not forget, with all of that, they're losing $500 million a quarter, and so it's which is real money even in crypto land. So it just doesn't. The whole thing just doesn't make sense. And I mean, it seems to me the most cogent bull argument for the equity is as well. It was, it used to trade higher, but tell the Carvana folks how much that helped them. Yeah. At the end of the day, it's the stock doesn't know where it comes from, and it's a reflection of the current economics and the business model. So, it's a head scratcher even here. As far as I'm concerned, but look, you raise lots of interesting issues here, and I think that The issue is it a shadow bank is an important one, and because they're a U.S. entity, will probably be addressed sooner rather than later in light of the current environment. So I think these are all valid issues in their business model and how they book revenues and whether or not they'll ever be profitable. It appears that when you've got a business model depending on, as I've called it, a predatory junkyard of just trying to extract fees from unsophisticated investors, you can do that for only so long, and before it gets either regulated away or competed away.
And you had your other question on Block also, right?
Oh,
Ricky?
Yeah.
Yes.
Yeah. So Block has, Block, as you point out, they gross up their revenues by including the gross value, and yes, of course that's misleading, and that's why their margins are so low in that business. And we don't give them a lot of credit, nor does I think the market, for their crypto business. I mean, it's really seen as more of a pure fintech play, but that's problematic for its own reasons, as we've talked about, that the core fintech business is a lot riskier than people think.
Okay, well, thank you, and kudos. By the way, I've been following you for some time with the China short, etc. So I'm sure you've heard it, but kudos again.
All right, let's bring up the Canadian wheat farmer, Chris.
Hey, thank you, Jennifer, for having me on. Much appreciated. Jim, big fan. I think you're the voice of reason in a lot of crazy financial times here. So thank you for being that. My question is, at a macro level, do you anticipate us going towards like a pension funding crisis? Because if on a look forward basis, you could make a very strong argument, as you has, that returns are going to be suboptimal, and these pension funds have invested in private equity, to your point, that have unrealistic marks. So there's a lot of pension funds that could be underwater if we experience anything close to that time period between 1966 and 1982. There. Thanks.
Yeah, thanks. So I'll restrict my answer to just specifics that we talked about, and that is, I really, you want to kind of avoid, like the plague, anything that the large institutional world has finally figured out and is a free lunch, because there just basically aren't that many free lunches, and certainly not in the size of trillions and trillions of dollars in the marketplace for long. And the institutions have figured out that the private sector, whether it's private equity or venture capital, is a free lunch. And it's not. And it scares the heck out of me. The amount of money that's still being raised by private equity funds and venture funds is just nothing short of staggering. And again, it gets down to people paying a premium, as my friend Cliff Asness says, for volatility suppression. And in that, these lovely, nice 10% to 12%, smooth returns are absolutely catnip for the institutional world. You're going to give me double-digit returns. You're going to get me twice my bogey if I need to earn 6 or 7% per year, and you're going to do it with low volatility. Where do I sign up? And I don't care if you're charging me, 2x the fees that normal fund managers charge. This is worth it. And the question is, what kind of risks are you taking for that free lunch? And in an environment where for the last 40 years, interest rates have gone from 14% to 0, and PE multiples have gone from 7 to 20 on top of economic growth, you literally could not ask for a better business model than to be in private equity over that period. Now, if you're going to tell me that you're going to replicate those macro tailwinds in the next 40 years or 20 years, God bless. But interest rates aren't going 14 points lower from here. And in my opinion, and multiples aren't going to triple from here. So it's a really skewed risk reward at this point to risk. And I mean, there's so many other problems. For example, private equity, which has now is earning what I said. Keep in mind that the stock market has kind of earned that over the past 10 years. And so the question now becomes, are you getting the stock market obviously is more volatile, but are you getting all that extra return for the extra fees? And increasingly, the evidence seems to be, and Dan Rasmussen and others have done great work here, that you're not, that you're getting basically stock market kind of returns for taking maybe 2x or 3x the stock market's risk. And you just haven't seen it yet because of the way volatility gets reported. And so there's just all kinds of storm clouds that are on the horizon here that I don't think large pools of capital are addressing as they just continue to pour more and more money looking in the rearview mirror in private equity and venture. And I just think that's the big crack up coming. Now, what it does to pension funds, it's not going to be good. And the good news is a lot of pension funds have gone from underfunded to overfunded in the past decade because of returns. So there's more of a cushion that's been built up, and higher interest rates also has a beneficial effect on pension liabilities. You discount them back at a higher rate. So there are offsets. So I never really worry too much about pension fund crack-ups. But the drivers of pension fund returns is going to be the bigger issue. And there, just this massive move from public markets to private markets. And it really is massive. I mean, I can't emphasize enough how much of these large pools of pension funds and endowments and sovereign wealth funds have changed their portfolio to, in effect, get riskier as the markets have gone higher by substituting public securities for private securities. Because the volatility, they're measuring themselves by volatility and not really the underlying business of leveraged corporate equities or higher beta technology stocks in venture portfolios. And I think that's going to be, in the future, in 5 years or whatever, we're going to be like, what were they thinking?
Yeah. Thanks for answering my question there. Yeah, totally agree. I would liken it to like a game of peekaboo, where if a baby can't see, you like when a baby closes its eyes, it might think you no longer even exist. Type of dynamic there. So it's similar to private equity, right? Whereas if you can't see it, it doesn't exist. Right? But I'll drop down. Much appreciated.
Thanks.
All right. I think we're going to take one last question. Gaurav Singh.
Thank you. Hi, Jim. Big fan, as everybody else over here. Just a couple of questions. Firstly, you've talked about China real estate and you talked about US CRE. What's your view on Canada real estate? And the second one is, what are you thinking about Europe, given all the dislocations because of Ukraine and the energy crisis over there? Any particular sectors that you think are particularly vulnerable in Europe? Thank you very much.
Yeah, thank you. So Canada real estate is expensive, and it's been so for years, right? I mean, it never really revalued after the GFC, and just went on to scale new heights, and particularly residential, but kind of everywhere. The real estate culture in places like Canada and Australia is even more embedded than it is in the U.S. I don't know if it's a Commonwealth thing or what, but boy, I mean, take a look at real estate prices in Australia still. we've looked at the problem with the from a short seller's perspective is that so much of the risk in Canada is socialized that it's there are plays, but I'm not going to talk about them. It's a lot more difficult to express bearish views on the Canadian real estate sector. If you own a lot of properties in Canada, I'd probably be lightening up. That's for sure. But I have no macro thoughts on Europe. Again, when we come up with a macro theme like China, it's because the bottoms up work. In China, it was due to commodity prices in 2009, and that led us to the amount of real estate construction they were doing, and led us to the banks and real estate companies. But who knows what'll happen? We have a land war in Europe for the first time in 80 years, and an awful expensive land war in Europe, and all kinds of unforeseen things can happen with that. So I have no idea. The EU is front and center in all that. But I don't have any views that you wouldn't have, or anybody else on this call probably wouldn't have, in terms of any macro impact. We have a number of European situations in our funds, but not many. The excesses have really been in the U.S. in the past handful of years. Whereas if you looked at our portfolio in 2010 or 2012, you would have seen a lot more Chinese exposure, a lot more EM exposure, and a lot more European stuff, financials and whatever. Other than the odd wire card which we had in 19 and 2020, we don't have a lot of idiosyncratic shorts in Europe right now, because the good ones are all kind of over here. So,
Jim, this is Aaron.
Thank you, Jim.
Jim, this is Aaron Arvidland. I just wanted to jump in with one last question.
Yeah.
Can we have you back on maybe sometime soon to talk about some of the risks in private equity? Because it's kind of a big interest of mine, and you've spoken really eloquently about it.
Well, I mean, so pensions and investments, Jen. I mean, I do sit on investment committees, so I kind of see it, including some large ones. So I do see it as an allocator as well as an observer. And I kind of liken it a little bit to hedge funds post the GFC, where it became increasingly obvious to investors that hedge funds were not the panacea that they were in the previous 10 years. Mm-hmm. Most hedge funds kind of made their chop in the long short world in the .com era. They avoided the craziness, or were short it and were long value, and that just paid off really immensely from 97 to 07. And then, like everybody else, they got caught up in the GFC and bought value stuff all the way down, and got killed, and have really been struggling ever since. And I just worry that we're on the same precipice with private equity, just paying up. I'll leave you with this. Just consider the following mental model with private equity as it relates to a short seller. Mm-hmm. If I told you that I was going to short a bunch of publicly traded companies, but I was going to short them, I was going to announce when I was shorting them, and I was going to short them after they had dropped 30%. And I was going to charge you twice the fees that I had been charging you, in prices that are relatively efficient, in an efficient relatively efficient securities market, you would laugh me out of your office. But how is it that private equity that routinely will buy companies at a premium to their publicly traded prices routinely and leverage them up and then charge you 2x the fees is a winning business model? You have to assume that the securities markets are massively, massively inefficient to basically say that strategy will return a large premium over other strategies. And I just don't think the securities markets are that efficient. So, well, Jim, now they're buying from each other, so that doesn't happen. Well, no, it does happen, because then what you're saying in that case is that you're buying from another smart private equity guy what he doesn't want at a premium. Mm-hmm. And so it's the same problem. And for people to say, well, Jim, you're not assuming that there's efficiencies that private equity can bring to companies that justifies these large premiums that they pay, I would fire back at you that, are you telling me that securities prices don't reflect the possibility of private equity buyouts? Of course they do. Of course they do.
So I'm going to keep you to that, and we want some names and phone numbers.
So, Jim, I know I keep saying that we're going to end this, but I keep getting badgered with requests to ask questions. Juno, do you want to ask your question right now? You can
Yeah. Could you hear me?
Yep.
Yeah. Good morning, everyone. My question is simple. Yeah. So everyone, hello.
We can hear you.
Oh, okay. So everyone expects a lower November CPI data, and thus a center rally may come. My question is, if Federal Reserve rate hiking keep longer and higher, so when and how the recession will come, and is the lower CPI data already be priced in the current market? That's my question.
I have no idea. That's my answer. I'm trying to predict where the macro stuff will play out short term. Your guess is far better than mine.
But just going back to that, Jim, we have a lot of traders and investors on this call. You do still think that there's a lot more room to go with the bear market?
I just think there's a lot of risks. You never know for sure, right? I mean, we all have our opinions. I would say that if we're about to embark on a new bull market, it will be the first one in modern history that starts at 20 times earnings. How's that? So if we're at roughly 4,000 on the S&P, I looked last night on the S&P website, and for calendar 2022. The new S&P operating number is $202. So we're at 20 times. So, yeah, I mean, anything can happen. But I would say that if you look back at the bear markets in my investing lifetime.
Are you still there, Jim?
Thank you.
So are you still there, Jim?
Sounds like you might have had some technical difficulties.
Jim, I think, you might have some Wi-Fi problems.
Be a lot lower.
Oh, I think he's back.
There, Jim?
Yeah, I've got to kind of wrap this up because I've got 11 o'clock.
Okay, what one last question. What advice would you give traders, investors right now in this cycle?
Just pay attention to the risks in your portfolio, and if you do that, the returns will be there. That's I know it sounds like a bromide, but it happens to be true.
Okay, wonderful. Thank you so much to legendary short seller Jim Chanos. Thank you, Jim. Thanks, everyone.
Thanks, Jim. Bye.
Thanks, everyone.
Thanks, Jim.